Welcome students. We will see the stock market, how it performs the transactions and all. We'll see in this part. So we'll see the dealers versus brokers, the New York Stock Exchange, license holders. Formerly they are known as the members. Now they are the license holders, entitled to buy or sell in the exchange floor. The operations takes place. If it is a small order or round lot, the operations are taking place automatically. If it is not a round lot, if it is a complicated order process, then we take the floor activity or a broker's involvement is required. So then the floor broker comes into the picture. Then we have super display book system, SDBS. As I said you, if the orders are in hundreds, which is called technically round lots. If it is a round lot, then it is called as a small order. 100, 200, 300, 500. These are the small orders and small round lots. If these are small round lots, then what happens? There is no need of a floor broker involvement necessary. It the order automatically takes place electronically through a specialized system called SDBS, Super Display Book System. In milliseconds, the order takes place because it is a round lot and it is for small number of round lots. So the order takes place in fraction of milliseconds through the SDBS. What if the order is for 15,000 stocks of Apple, 19,000 stocks of HP, 23,000 stocks of Amazon? Like that, the order is a huge order and also not, maybe sometime not in round lot, in kind of complicated orders. Then SDBS will not work in that process. Broker will make the kind of deal. He will find the best buyer, best seller, and he will close the deal. Then the broker's role will start there. Then SDBS is operated in whose account? In the dealer's account. So license holders will be there. They will have the stock of they will have the kind of inventory of the particular stock in responsibility of them. They will create a kind of smooth flow of transactions. They will provide proper liquidity to the stock they are taking care, and the SDBS will execute the order against the particular dealers or license holders inventory when a buying order comes or a selling order comes. But if it is a clumsy order, if it is a complicated order, if it is a huge order, if it is a bulk order, then the brokers will come into the picture to make the deal. Now comes to the different type of orders. Market order, where you specify the ticker and the quantity. Immediately it is executed at the best available price. For example, you specify you need 500 stocks of Apple. Here you have given the ticker also, Apple, and the quantity also. In that case, it is a market order, and it will be executed by either SDBS or the broker immediately at the best available price. The market buy will be executed at the lowest ask. Market sell will be executed at the highest bid, because bid is the buying price and ask is the selling price. Now, opposite to market order, you will have a limit order. Here what happens? You specify the ticker Quantity, in the market order also you specified the ticker and quantity. But here, along with the ticker and quantity, you specify the price. For example, you say you need 100 stocks of Sabic at 88 reals. That means the broker will wait at that point of time till the price reaches 88 or low. He will not take your order. He will keep your order as waiting till your quoted price will come. Then he will execute. If it is a buy order, if it is a sell order, he will wait till the price to reach or above the price. Then he will execute. So limit buy can only be executed at limit price or lower price, as I said you. Limit sell can be executed only at the limit price or higher price. Up to that time, the broker will wait to execute your order because you have given a limit to him. But in a market order, no such limitations will be there. You just mention the quantity and the ticker. The broker or the dealer or the SDBS will deal at the best available price. Stop orders. Stop orders, the stop price is the trigger or activation point. There are plus, there are minus in this kind of stop orders. Means there are advantages and disadvantages. Why? Because once the stop order is set, the stop order, the system will execute the order once the price reaches that point. If the stop price is reached or passed, the order will take place, becomes a market order, and it will be executed immediately at the best available price. For example, you will fix the stop order at $72. Once the stock price will reach 72 or lower, it will just 72 will be executed. Most of the time what happens, price will cross 72, come 71, 70, again immediately it will reach to 79. Then you are a loser. Why? You put a stop order at 72. System immediately took the order at 72. Once it crosses 72 below, your order has been executed as a market order. But next 15 minutes only the price reached to 79 and you became a loser. Why? You were busy. For example, I am teaching. I am busy in my class. I put my 72 limit order, stop order. I was in the lecture. The order has been taken place and at 72 it is being sold. Finishing the lecture, when I opened the market, I saw the price is 79 and my stock has been sold at 72. Why? Stop order already fixed. So I just give the stop order, so the system has executed. The SDBS has executed the order. So it is the risk. Same for selling also. So this is the kind of, if you give one price, if reaches this price or more, you sell. You sold it, after that price has bounced back and you became a loser. So these are the kind of risk also there. Price suddenly plummets or rises and the execution price is much lower than the price which is expected. So stop order has this disadvantage, but advantage also. For example, you have, what is the advantage of stop order? You fixed 72. You are in your job. For example, I am in my class and I put 72 as my stop order. One particular stock started, because of some bad news, the price started going down. What happened in mobile case? In one day, the price from 82 became less than 10. So, in that case, what happens? I am busy in some duty. I could not see the market news, and the price from 80, it has come 8. If I don't have stop order, then my price is, in the before day it was 80, next day it is 8. And I am loser of $72. But if I put a stop order for $72, then what happens? 80, 79, 78, 76, 75, 73, 72. Once it reaches 72, automatically my sale will be take place, and just I'm just at very safe position, because the price goes below 72, 71, and whatever price goes, I'm not a loser. I sold my stock at 72. So this is the kind of benefit of stop order. But the loss, as I told you, what if the price again bounces back? Then you are a loser. So this is the kind of the quote is being given here for NASDAQ. The National Automated Stock Dealers Association quotation is being given, as you know, NASDAQ. The level 1, level 2, level 3 are being given here. Large portion technology stocks, and NASDAQ, you know, most electronical communication network, that's the minimum manual thing happens here, and it is a kind of automated trade, as the name itself, automated quote. Plus AQ stands for automated dealers, automated quote. So it is a electronic market. And here is the stock market reporting. 52 weeks high 35.68, low is 21 point. For the stock gap, it is being given. So gap has been as high as 35.68 last year, and gap goes, the lowest price of gap is 21.02 in the last 1 year. 0.92 is the dividend paid per share, 92 cents paid as the dividend. The dividend yield is 2.77%. How it is calculated? Dividend paid divided by stock price that day is equal to dividend yield. The price earning ratio is 15 times. That is equal to, we have seen the price earning ratio. Price per share divided by earning per share is 15 times. The number of shares traded per that day is 8,829,800 shares traded, hence in the last day's trading. The closing price is 31.61, which is 45 cents more than yesterday's closing. So this, now let me stop the recording.